Hi everyone. So today in this session we are going to see the most consistently asked question once again in SFM. I don't know what students are having a doubt with regard to this particular area called as a fate of forwards. Consistently so many people are putting the message in the group regarding this particular problem we couldn't solve. Okay, initially what I thought is when they understand the normal cancellation concept, this concept is also similar. Might be they understand, but still okay, no problem. Today in this session, we are going to burst all the myths regarding this particular concept called as a fate of forwards. When it comes to the fate of forwards, most of the doubts which I am finding from the student's point of view, sir, what is this cancellation rate? What is this swap loss? What is this concept of interest on outlay of funds, interest on inflow of funds? We couldn't understand. General cancellation, general extensions we can understand, sir, but special concepts are there. Those we couldn't cover. We couldn't understand. So in this session, I am going to cover all such concepts. Okay. Two problems I will take. Two are, one is an RTP question, another one is a direct study material and exam question also. Similar type of questions will come in examination. If you understand these two, one will be on early honor, second will be on late extension. Okay. I will do two questions. With these two questions, you will get a full clarity. I suggest every one of you listening to the lecture, one important thing. Please copy the notes along with you. Hardly this video will be for 1 hour. Okay. Okay, 1 hour. At this peak of a moment, yes, definitely 1 hour is valuable. But this 1 hour session, if you listen properly, no doubts will come with regard to the swap loss, cancellation rates, interest on outlay of fund, interest on inflow of fund, cancellation rate, new contract rate, total cost to the customer. Every single point I will be covering just in 1 hour time. Okay, we are going to cover all these concepts. I am not going to kill any 1 minute of your time. So let's focus on this. And at this peak of a moment, if you remember these concepts till the exams, you will definitely remember. You will do very well in the examinations. So with that intent, let us move on into the main concept. Let's roll the main concept intro. See here. This is the question I have extracted from RTP. Okay. Let us see the question first. Facts. Question they will frame in a paragraph format, but these are the facts. 19th Jan, bank entered into a forward contract with customer. Forward contract with whom, sir? Customer. To have a trade of $7,000. To have a trade of $7,000. At what price? 46.67. Delivery on 20th of March. 19th January, bank covered its position in interbank market by a forward by delivery 19th March at the rate of 46.6550. Customer approached the bank on 19th Feb requesting for an early delivery of dollar. Rates in interbank market on 19th Feb in interbank market are as follows. Spot $1 equal to rupees 46.5725, 46.5800. March $1 equal to 46.3550, 46.3650. Interest on outflow of fund 16%, interest on inflow of fund is 12%. Flat charge of 100 rupees. Calculate net amount recovered from customer. Net amount recovered from customer. Okay. I will be putting this question before you on the screen. Okay. I request every one of you read the question first. Okay. Don't think that I will anyway explain this. I will explain. My part I will do. Your part also you do properly. Read the question. I will not spend more time on this. Okay. Just 2 minutes time I will give you. Please read the entire question clearly. I will solve and I will put you the notes. You take photo or you write the notes. Writing the notes is suggested. Okay, if you want to go against to my suggestion, you at least take a photo of the answer. Okay, it's better to write because you will remember. Notes means I am not writing paras and paras analysis like in the normal notes. Summary I will tell from the exams point of view. What is required from exams? Copy that at least. Okay, please read the question I am putting it before you. Some audio issue. Uh, Read the question? Okay, let us start with analysis. Okay, see here. First point. When a question comes in examination on forex, and especially with regard to the, when a question comes in the forex with regard to the forwards, okay, with regard to the forwards, the first very important thing, the thing that you need to remember is, question is given from whose point of view. Okay, whether the cancellation concept is given from customer point of view or from the banker's point of view, from whose point of view they framed the question, first you need to understand. Sir, how can I understand, sir, whether they have given from customer point of view or bank point of view? How can I understand? Listen, they will clearly give in the question cancellation rate, swap loss, like that. Then you first fix in mind, they are asking you to make all the calculations from banker's point of view. Information is similar, but they are asking only what is the cancellation rate, what is the new charges, etc. Then question was given from customer point of view. Question was given from customer point of view. So first thing, understanding and identifying which kind of question it is. If it is given from banker's point of view, whatever the rules I am going to tell now will apply. Listen carefully. There is a concept called as FIDI rules. What is the concept, sir? FIDI rules are there. FIDI rules will be applied for calculation of forwards. For calculation of forwards. But I am not going to complicate by dealing with that. I will not tell what is a FIDI rule, but I will directly do the problem by applying the FIDI rule such that you don't need to again remember the FIDI rule separately. Okay. So unnecessarily, let us not do overaction at this stage. No need of understanding, no need of reading FIDI rule now. Okay. No Vijnana Pradarsana. Let us understand how to apply that FIDI rule. That's all. Application, if you understand, theory also will be same. So no Vijnana Pradarsana at this stage. Let us try to understand what is a FIDI rule with regard to that. I don't even tell that this is a FIDI rule. I will tell only the practical rule behind this. You apply that, you will get the answer. Okay. Just spend this 1 hour time. No doubts in regard to the forex with regard to the fate of forwards through cancellations and early honor. Okay. Now listen. Let me first summarize. First, customer point of view. I will give you one example. On 1-1, you go to my recent fast track lectures that were uploaded in the YouTube. Playlist was created. Check where the forex chapter was dealt. I think in video number 3, 8 hours or 9 hours video is there. In that I kept forex cancellations, early honor, etc. There I said about all the customers point of view there also. Okay, you can go there and listen if you have doubt also on customers cancellation concept. Okay, so first let me summarize, because without understanding this you can't understand bank point of view. 1-1, a customer entered into a forward contract expiring on 1-4 for a forward buy. For a forward buy. Okay. On 1/2, on 1/2, he came to the bank. He came to the bank, and he said the bank that bank, I cannot buy after 3 months or 4 months. I want to buy at the end of third month only. I make a early honor. I make a early honor. Request I put before the due date. 1/2 I went to the bank saying the bank, I don't want your dollars today. I want the dollars after. I don't want the dollars on 1/4. I want the dollars on 1/3 itself. That means I made a request early for a early honor. So I said, I don't want to buy on this date, but I want to buy on this date, forward buy. But no contract can be cancelled. Contracts can be cancelled not directly, but the contracts can be cancelled by a counter transactions. Okay. So listen, in a bank statement, if you see bank statements, if you open, sometimes by mistake bank will charge the bank charges. What they will do, they will make a contra entry. They will not strike the transaction, because once you entered into the Nostro account or exchange position account, you can't change them. You can only make a contra entry to them. So on 1/2, I have to cancel the contract entered on 1/4. For that, forward buy. For 1/2, 1/4 will become forward. Buy will be reversed through sell. These are the three transactions you make for early honor. Okay. I will also explain for extension. On 1/1, I entered into contract of forward buy. I entered into contract of forward buy as a customer forward buy. Okay. Now on 1/1, I entered into contract expiring on 1/4 for a forward buy of dollar. On 1/4, I went to the bank and I said, bank, I cannot buy today. I wanted to extend to another 2 months. I want to buy on 1/6. I want to buy on what, sir? 1/6. That means for 1/4, 1/6 will become forward, and I want to create a new contract of forward buy. But who will take the forward buy contract? You have already entered with me on 1/4. I went on 1/4 to cancel the first created contract. For 1/4, 1/4 will become spot. For buy, it will become sell. With a spot sell, you will cancel that forward buy. These are the points that we have already learned in the revision classes, in my regular classes, in my extra exam oriented batch. Everywhere these concepts you have learned. Okay. This is all customer point of view. There is another point of view called as banker point of view. Another point of view called as what's a banker point of view. So let us understand from the banker point of view. Everyone, please listen to this very, very carefully. On 1/1, bank entered into a transaction of a forward sell. Forward buy to you will become a forward sell to them. Okay. Okay. Now, you came to the bank on which date? 1/2. And you said that bank, I cannot take the delivery on 1/4 expiry. I will take only on 1/3 expiry. Okay. That means you want it to enter into another forward or not? So they will create a new contract of forward sell. They will create a new contract of forward sell. Okay. Now on 1/2, the contract which you have already created should be cancelled or not? Yes. On 1/4, you will make a forward sell. It will make a forward buy. Exactly reverse. But you should remember one point. Like this, if it apply, everything is normal. Students wouldn't have pressured me to make this video. So many students are consistently asking me the question, means something is going wrong beyond this. Okay, something is what? Going wrong beyond this. If exactly same thing is going to happen, what you apply for the customer, reverse you apply for the banker, game over. But the problem comes here. Why problem will come? That let us see the question and try to understand. Hope you understood now. This is not the procedure completely we are following. This will also be there. Along with this, some additional transactions will come, which makes this concept more complex. Okay, that only we are going to analyze now. Okay, so many students, this is the highest times asked question. Please make a question on fate of forwards. Okay, so many videos are available on YouTube, but still you are asking me. There is no clarity here. You will definitely get a clarity today as to what really this particular concept of cancellations, early honor, etc. will be made in a real life scenario from the examination questions and RTB question point of view. Let us make it. Okay. Now see the question. On 19th Jan, bank entered into a forward contract with a customer. Okay, $7,000, 46.67, delivery on 20th March. Next, on 19th Jan, it covered its position in the international banking market, also called as the interbank market. Interbank market means international banking market by a forward by delivery 19th March at 46.6550. Customer approached the bank on 19th Feb requesting for a early delivery of dollar. Okay, rates as on 19th February they have given interest on outlay, interest on inflow, and flat charges also given, net amount recovered from the customer. This is what the question they are asking us. Okay, first I will write down summary of transactions. I will show you the notes again. Summary of transactions. Okay, everyone, first listen and observe properly. Okay, first from the banker point of view. From whose point of view, sir? Banker point of view. Okay, now number one, first, what bank has done? Tell me that. Bank has originally entered what? Bank has entered into transaction with the customer. Okay, what transaction? 19th January, it entered into a contract expiring on 9/23 for a with a customer. With a customer. Customer is buying from me. Bank is selling. Forward sell. Simply this customer is a importer. Importer will buy. Banker has to sell. Okay. Forward sell. At what rate? 46.6700. Okay. 4 digits always. 46.6700. Okay. Now listen. Bank has entered into a forward buyer, forward seller, forward sell. Okay. Now to sell, first I need to have dollars. Na? I can have dollars in two ways. If you don't understand what I said, rewind and listen. Go back and listen. But I will tell only once very clearly. I repeat for the one last time. Please listen. Customer is the person with whom bank is entering into transaction. On 19/1, bank entered into transaction with a customer expiring on 23 for a forward sell. Customer is making a forward buy. Bank has to make a forward sell. At what rate? 46.67. Okay. Bank entered into forward sell with the customer. We are seeing from banker's point of view. Bank is forward sell. To sell on 23, first bank should have dollars or not, $7,000. How bank can get? In two ways bank will get. Way number one. On 23, over the counter, one of the customer came. Over the counter, customer came. Customer gave 10,000 or 20,000 or 8,000 or some dollars he has given. In that, I will buy or not? I repeat, on 23, listen to the date. On 23, two persons will come. This customer will come. Normal other customers also will come. This customer will buy. Other customers will sell to me some dollars on the day or not. Those dollars I will buy from them and I can sell to the customer. Which customer? This customer with whom I already entered into forward buy. But this is a risky task. But this is what's a risky task. Reason is, on that day, if the dollar is 48, I have to buy at 48 and give it 46.67. Therefore, it is always a loss for the banker. Therefore, what the bank will do? The moment a customer came to me and asked for a dollar buy forward, first what banker will do? Banker will first open a website called as interbank markets. Websites are there. Very popular is XE. Okay. You can also search on web. xe.com will give the details of the interbank transaction rates. Okay. There they will go. Over telephone calls also they can manage. Let us say I am a bank manager. You came to me, you asked me, I want $7,000 expiring on 23. Then I have to buy and give you or not? For where I will buy? Yeah, always customer buying on that day, I can't guarantee the rate. Therefore I will call the interbank market. I will ask, what is the rate traded with you today? That means first what bank will do? Bank will enter into interbank transaction on the same day, expiring on the same expiring date, for a forward buy. Banker enters into forward buy. Forward buy with customer with the interbank market or interbank. To the interbank market, this bank, India bank, is the customer. Generally bank buys at lower rate, bank sells at higher rate. That is with whom? If it is bank and customer. But here our bank entered into interbank transaction, our bank is customer, that bank will be the main banker now. So what will happen? We entered into forward buy. We entered into forward buy with whom? With the banker. Which bank? Interbank. I will buy in the interbank market and I will sell to the customer here. The advantages of interbank market is, interbank market don't charge margin. Interbank market don't charge margin to the other bankers. Bank charges margin to the customer, but the interbank don't charge any margin to the bankers. That's the advantage of transacting to the interbanks. Okay. So, and moreover, interbank market is like a wholesale market. Cheaper rates for dollars are available. I will buy there and I will sell here. Okay. Now listen. The question said that 19th Jan, the bank covered its position. That means banks don't want to put their position naked. They don't want to put their exposure uncovered. They will cover their exposure. That means I promised one of the customer that I will sell dollar na. From where I will get? Yeah, I will print dollar. I am not a Fed to do that. Okay, I am not a Fed. If it is a Fed bank like in USA Federal Bank, that will do. I am a bank in India. I am SBI. SBI, how can it print dollar? It can't do anything. Therefore, what they will do? They will first enter into a forward buy. That's what he has clearly given. It covered its position in the interbank market by a forward buy. Delivery on 19th March. 19th 21 day. You can ignore. I have written 20 here. You can also take 19. Because one day before I will buy and 20th I will give. At 46.6550. 46.6550. What do you mean by this? At this rate I will buy in forward and at this rate I will sell. Sure gain I will make. Am I clear? On 46.67, margins can be added in the question if they give. In this question they didn't give. Next question is the worst question. In that question margins also given. There I will adjust the margins and show you. In this question margins are not. They leave off. Okay, if you want to add, bank can add margins to customer. IBM will not charge margin to our bank. Okay. I entered into these two transactions. First, hope everyone understood the summary of the first transaction. This is what happened. But you have to interpret this properly. Customer came to you. He said, I want to buy dollar. I said, what? What you want to buy? He said, I want to forward buy dollar. Okay. Immediately, first I will make a phone call to the interbank market. I will ask, what is the forward buy? Okay. What is a forward buy for me with you expiring on 23? It said 46.6550. Depending on that, I will decide 46.67 to my customer. First, I will not decide 46.67 and then call them. First, I will decide about 46.6550 and then I will call my customer and tell, okay, my price with you will be 46.67. The balance will be my profit. I will also add some margins to that. Understood the concept? Okay. Second part. Part 1 over. If everything is going correctly, this is how the situation has to be. But everything is correct means why it becomes life? So this life kichdi. Therefore, what happened here? Something has happened to the customer which made him in trouble. He troubled the bank in advance. Customer approached bank on 19th Feb. Okay. And what he said? He said that bank, I don't want to wait till March. I want to make early delivery. I mean, I want early delivery of dollars expiring on 19th Feb itself. Okay, see here. On 19th Feb, customer went to the bank. So first, customer, okay, customer went to the bank, and what he said? Bank, on 19/2, he said, bank, I don't want to take delivery on. I don't want to take delivery on 19/2, sorry, 23 or 19/3. I want to take delivery on 19/2 itself. I want to take delivery on 19/2 itself. That means he wanted to wait for 1 month. He didn't want to wait for 1 month. He don't want to wait for 1 month. Means this customer is asking for a spot buy. What it want? A spot buy. To buy, to spot buy, bank has to spot sell na. From where bank will get? Yeah, immediately bank will do the following. So this is only to understand. I said I am erasing this. Now IBM, bank will have to buy today itself. Bank, our bank went to the interbank market on which date? On 19/2. It went to the interbank market, transaction expiring on the same day, to make, okay, to make a spot buy. Why to make a spot buy? I have to make a spot sell to my customer. He came and sat in the bank. Okay, he's not moving from the manager's cabin. Okay, मैं अंदर नहीं जाऊंगी, मैं देखूंगी dollar. So he's staying in my office. So he said that I don't want to take the delivery on 23. I want to take delivery on 19/2 itself. So istava chastava, will you give or you will die? So immediately this banker said, Are you came, you are cancelling. Anticipating that you are a topesh, I entered into forward buy contract already with the international bank market. You gave a big twist to me. Let me come out of the twist first. I will first call interbank market and tell interbank market. Do you remember me? On that day I made a phone call to you. He said, oh my dear, you are going to come after 1 month. No, I want to cancel that. He said, then why you came? You cancelled the contract. No. Today I want to buy. It said, I will make a spot buy from you. Okay, I will make a spot buy from you. On 19/2, today 19/2 na, my customer came and sat in the bank. Yeah, he's not moving. He's asking dollar now itself. I will buy from you and I will sell to him. Okay, spot buy in the interbank market. Tell me, who is buying? Our bank is buying. From whom? Interbank. So tell me, our bank has to buy from the interbank. Means interbank has to sell or not? Interbank sells at what rate? Higher rate. Higher rate means ask rate they will apply. I repeat, like customer you interpret. Our bank is a customer there. Bank being the customer to interbank went to the interbank to buy. Interbank has to sell. Interbank sells at a higher rate. Higher rate will be ask rate. So ask of what I am going to buy? Rupee dollar. Okay, see the transaction information. Rates on 19th Feb. Spot buy. Bid ask. March relevant, spot relevant, spot I want to transact. Okay, 46.5800 is the ask rate. So where I am writing? Here. Rupees 46.5800. 5800. At this rate I will buy. Okay, this is A. B transaction also I will do. With the interbank market, I have to cancel already entered forward buy, because as per the customer's request, I already entered into a transaction with the interbank or not. On 19/2, I have to cancel the transaction entered on 23 by giving a forward buy. 19/2 23 will be forward. Buy will be cancelled through what? Sell. Sell means reverse rate. In our bank has to take a rate as if we are selling. Interbank has to buy. Interbank buys at a lower rate. Lower rate will be bid rate. Bid of rupee by dollar. Okay, bid of rupee by dollar. 1 month forward means March forward. Bid rate. So tell me, March forward bid rate. March forward bid rate 46.3500. 3550, sorry. 46.3550. That's all. Okay. These are the summary of the transactions that are given in the question. Simply always remember, interest on outlay of funds, that adjustment will be done between the banker and the customer, not between the banker and international banking market. So international banking market lo what happened is irrelevant for interest on outlay of fund. That means with the customer, what transactions you are doing, only for that interest on outlay of funds will be applied. So meaning, I will show you through numbers you can understand. First, swap loss. They will ask in the question, na, swap loss. Swap loss is a loss which happens between the transactions with interbank market. Transaction with interbank market means what? I swapped my positions. Swapping my positions in what? In the interbank market, I swapped my positions because of you. How many swaps you made? On that basis, the loss will be calculated. See there. See the question and tell. How much is the spot buy? How much is the spot buy? Take calculator. 46.5800. Okay. At what rate you are going to make a forward sell? At what rate you are going to make a forward sell? Forward sell means to cancel this contract you made a forward sell. Na? Sell rate is 46.355. So 0.2250 is a loss that happened. Buying is at 46.58, selling is at 46.3550. There is a loss or gain, a loss. How much? 0.2550 for $1 into 7,000 will give you 1575 as a total loss. 1575 as a total loss. 0.2250 is per dollar. That's what we have done here. This is the answer. Swap difference. Bank sells at 46.3550. Bank buys at 46.5800. Swap loss 0.2250. So total loss will be 1575 for $7,000. Next, interest on outlay of funds. Okay, that's the first bit. That's called as net amount. First one is swap loss. Second one will be interest. It can be inflow, it can be outflow. Early delivery is made. Yes or no? Early delivery means he is taking a early delivery. Yeah? So early delivery means bank is going to get a benefit. Bank is going to get a benefit because money is receiving much earlier. Generally, bank has to pay interest. Bank has to pay interest. Example, I will tell you. If, see the numbers, if bank has to make a forward sell, bank has to make a forward sell. It has to sell at what? 46.67 it has to sell to the customer. Okay. By buying at what rate? By buying at 46.5800. 46.5800. Because customer came on 19th February and he said, I want to buy today itself. If you want to buy, first I have to buy in the market or not. I bought at 46.5800 and I am selling at 46.67. 46.67. So 46.5800. Okay, 46.5800 minus 46.67. 46.67. That means company or the bank can sell at 46.67 by just buying at 46.58. This benefit is 0.09 into $7,000, 630 rupees into how many months? 1 month. 12% is the inflow interest rate into 12% into 1 divided by 12. How much? 6.3 rupees. So bank sells on 19/2. Okay, 46.67 is a agreed amount. We agreed with the customer. Okay, bank has to originally buy at a rate. Originally buy at what rate? 46.6550. 46.6550. Okay, 46.6550 it has to originally buy, but it originally bought or not yet bought. It has cancelled that through Okay, it has cancelled that through a forward sell. Okay, for that already we calculated the interest. Now what we need to do? Next step is interest on inflow. It's not outflow now, because bank has to sell at 46.67 by buying at 46.6550. But now I am buying only at what rate? 46.5800. That means because of you asking for early delivery, I am buying it at much lesser rate or not. What is the profit? 46.67 minus 46.58, 0.09 into 7,630 into 1 by 12 will become 6.3. This is the amount that the company has to pay. The bank has to pay to whom? Customer. Flat charges of 100 is also there. So the total charges is swap loss of 1575, flat charge of 100, inflow of 6.3 to the customer and outflow to the bank. Net is 1668.70. Okay. Next, what is the total recovery? For invoice, I will collect. See here, what is the new rate we entered? What is the new rate we entered? What is the new rate we entered? 46 point. 46 point. So, to make the transaction, to cancel, this is a cancellation rate. This is the real transaction rate. 46.58. So, 46.58 into $7,000. 46.58. So, for invoice 46.67 I will sell. Okay, 46.67 into 7,000. How much? 3,26,690. 3,26,690. This is originally agreed amount. 3,26,690. 46.67 into 7,000. This is original agreed rate. Sale price do not change. My buying rate will change with the IBM. Previously, I targeted to buy at 46.6550. Now I'm buying only at 46.5800. So I will buy and I will sell you. Okay. So invoice amount is 326,690. Charges already we calculated 1668.7. We added that. This is the total cost recovery 328, 358.70. Okay. If you want, please copy the answer. I will give you 3-4 minutes time. No problem. You please copy down. Hope everyone understood this first question. Okay. Let us move on into another question. See there. Question number 59. Let us see. This is a question gave for examination for 8 marks. Similar questions are coming. If you understand this one question, enough. You need not do any other question. Practice this question for 1 or 2 times. It is more than enough for your exams. Okay. 59 and 60 are totally similar. Everything is same. 59 is much bigger ones. So I will do this. An importer booked a forward contract. Importer will always buy foreign currency. Customer buy, bank sell. Okay. Booked a forward contract with his bank on 10th April for US dollar 2 lakh. Due on 10th June at the rate of 64.4000. The bank covered its position in the market at 64.28. Believing that he will really buy, I first entered into buy contract. Okay, that means bank promised that it will sell at this rate by entering into contract with the interbank market at 64.28. The exchange rate for dollar in the interbank market, okay, in the interbank market on 10th June and 20th June. Okay, 10th June and 20th June, these are the rates given. Particulars. On 10th June, this is the spot. Okay, on 10th June, this is the spot. So spot June. Sir, spot already given, then what is the spot June? You should understand this as end of June. End of June. Why? I will tell you. In this question, there is a lack of one information. That's an assumption institute has taken. I will tell you what assumption it has taken also. Rates are given. Don't read the rates and waste time. 10th June and 20th June rates are given. Exchange margin is 0.1. Means if the bank has to buy, they will deduct this margin. Bank has to sell, they will add this margin. Interest on outlay of funds means directly they have given that there is an outflow, 12%. Importer requested on 20th June for extension of contract with due date on 10th August. Rates rounded off to 4 decimals in multiples of 0.0025. On 10th June, bank swaps by selling spot and buying 1 month forward. Calculate cancellation rate, amount payable on rupee on dollar 2 lakh, swap loss, interest on outlay of funds if any, new contract rate and total cost. These are all the various questions that he is asking in this particular question. Read the question for 2 minutes. We will start doing the solution together. Understood? Read the question? Okay. Now, listen. Summarize the transactions first. Summarize what's our transactions. First, I will write here. Number one. Number one. I will divide this entire question into 3 parts. Those 3 parts will help you to understand the workings as well. First point. See here. Okay, I will write here. Space is there. First, which date the contract was opened? Which date the contract was opened? 10th April, expiring on 10th June. Number 1. With the customer, okay, with the customer on 10th April, we entered into a transaction expiring on 10th June. Customer is making a forward buy. From banker point of view, we agreed a forward sell. At how much? 64.4000. A. B. On the same day, I entered into a forward buy with the interbank at rupees 64.28. I will call the banker interbank market. I will tell I want to make a buying on forward. How much? 64.28. Okay. So after knowing that the rate quoted by that bank is 64.28, I will tell them I will sell you at 64.40. Okay. Assuming that first rate quoted 64.40 is already inclusive of margins. Okay. Next. Number 2. What happened? The interesting point in this question is the exchange rate for dollar interbank rates are given. Listen, this particular customer has to come on which date actually? 10th June. And he has to buy or not to buy, and he has to buy. But the importer has came to the bank only on 20th June. Only on which date, sir? 20th June. Because of you not even coming on 10th June. That means bank waited till 10th June. 10th June also it waited. It waited for whom? It waited for the customer. Banking hours over. But still customer didn't come. Till now, all the problems before whatever we have done, request for extension will be made before the due date or at least on the date. But here, due date also over, but that person didn't come. Means, what is the first logic you have to understand? Bank waited, our bank waited till 10th June, but he didn't come. Who didn't come? Customer didn't come. With the anticipation that you will come, I entered into a forward buy contract with the interbank. I have to first cancel that. Whether you come or not, I have to cancel it. So, A. On 10th June, I have to cancel the contract created for 10th June. Buy reverse is sell. 10th June will become spot. I need to make a spot sell. I need to make a spot sell. Okay. I need to make a spot sell at what rate? 10th June. On that date, 10th June. You are making which one? Spot sell. For you, it is a sell. For that bank, it will be a buy. That bank buys at a lower rate, a higher rate, a lower rate. Lower rate will be the bid rate, 63.80. Okay, 63.80. First, hope everyone understood up to here clearly. Yeah. Next, B. What happened? Let us see. So, sir, really this answer is correct? 10.6 10.6 spot sell 63.8 correct? Let us check. He only said on 10th June, bank swaps by selling spot. Even though they didn't give in the question, we have done the same by the logic. Selling spot. Okay. And by buying 1 month forward. 10.6, it bought a 1 month forward. 1 month forward means what rate I need to take? From 10th June, 1 month means 10th July. This is spot July end. This is spot August end. This is spot September end. Okay, now this is spot June end. This is spot on 10th. On 10th June, this is a 10th June rate. On 10th June, this is the 30th June rate. On 10th June, this is July. Spot transaction for July. This is a 10th June, 30th August. Okay, like that you need to understand. Lack of information. What institute has done while doing this answer, that's a confusion the student will get. Okay, on 10th June, bank swaps by selling spot. Okay, understood. And buying 1 month forward. 1 month forward means which rate I need to take now. I repeat once again, what institute has done. See here. What institute has done is, okay, see here, 10th June. What do you mean by spot? 10th June, 10th June transaction. This is 10th June, spot on June end, spot July end, spot August end, spot September end. 1 month forward means they have considered not July end, they have considered the June end. This is assumption of this question. Okay, since clarity is not there with regard to the dates, they have considered, actually they have to give 10th July, 1 month means, but 1 month forward means June forward they have taken, June end they have considered. Are you understanding or not? Sir, why is a question now. See here, my customer came to me on which date? 26. That means by 10/6 my customer is not even traceable. Now I expected, who expected? Bank assumed that maybe at least this fellow will come on 30th September, 30th June. That means bank on the basis of expectation, generally bank don't do, but the problem suggested us to do that. Okay, problem suggested us to do that. Therefore, we are forced to do answer like that. 10th June, I first cancel the forward rate already created by making a spot sell. Clarity. This B point itself is based on question and the assumptions taken. First assumption, 1 month forward means in reality they didn't give 10th July rates. Okay, but July rates are 30th July. But institute, now I have two options available. I can take July rate, I can take June rate. Institute has taken June rates. Assuming that those are all the 30th June rates, and 1 month forward means they are taking 1 month end forward rate. Like that they assume. So 36, okay, 36 or 10/6, I closed my transaction expiring on 36. I entered into a forward buy, anticipating that at least this customer who couldn't come on 26, at least will come after another 10 on 10/6. At least he will come by 36 with some anticipation. They have some information. Okay, they have some reliable information that this customer will come on 36. With that anticipation, they enter into forward buy. How they came to know about this anticipation and news, that is not given in the question. These are all certain assumptions in point number B. One last time I am repeating. 10/6 banker has to cancel. Up to there, okay. But this one added point or additional point is a confusing point in this question, where question is lacking clarity. On 10/6, I have to cancel. I cancel. They created a new contract even before customer came, assuming that at least customer will come on 36 on the basis of some reliable information available with them. Maybe the persons working in that particular company might have said at least he will pay on 36. With that anticipation, banker first again entered into another forward buy. Our bank is buying. Okay, our bank is buying. This is entered with international banking market. Second one also I will enter into a forward buy with interbank market. At interbank market, we have to buy. That has to sell. This rate will apply. Rupees. With the interbank market, these are the two transactions that I will enter. These are the two transactions that I will enter. Number 3. Again, on 26, my customer came to me, smiling face. Now he said, bank, I don't want to honor that contract. I'm very sorry I couldn't come on that date. I will do one thing. I want 10th August forward buy. 10th August forward buy. I want an extension. Okay. 10th August. Which one forward buy for him? We need to enter into new forward sell. New forward sell. Okay. We need to enter into new forward sell. At what rate? Nothing is given in the question now. original rate of 64.40, you please sell me. Since he is asking me to sell at the same 64.4000 after 2 months, that means now it is June, July and August, after 2 months he is asking for delivery, and we said that okay, I will sell to you. To sell to you, first I need to buy na. So again, this particular bank should enter into a forward buy. Okay, so on 20th June, we will enter into a new contract expiring on 10/8. Okay, now answer my question. On 26, we will create a new contract for a forward sell. Okay, for a forward sell, we have to sell them or not? At what rate we will sell? At the rate which is agreed. Okay, see here. First two transactions, hope everyone understood. Okay, I will rewrite this for more understanding. This is also another confusing area, so I will realign and write. Yeah. With the customer, first we have to cancel. What we have to cancel? The customer has already entered into a forward sell buy with us, which we have created at 64.4. He didn't come. Anticipating that he will come, I entered into forward buy. That was already cancelled with a spot sell. Again I entered into a forward buy. What's a forward buy? Customer came and he said that, I wanted to buy. We first said, first let us cancel the old one. On which date you came? 26. On 26, anyway you came after the due date. On the same date, let us first cancel the original contract. Okay, if it is within the contract, I can take 64.4. Contract date, you have crossed. Previous problem, we have done the answer with the same rate because you have made the transaction early honor. Therefore, the same rate I will apply. In this question, what happened? Customer came not on due date and before due date. He came after due date. That means this contract of 64.4 is already expired by the time you came to me. Therefore, previous problem, if you observe the first rate, what they agreed is applied till the last because he came for a early delivery. So it's a benefit to the bank. Bank will tell that at the same rate I will continue. As per the FEDI rule, this is a FEDI rule. If the customer comes after the due date, the original contract what is created at that rate, we are not going to sell him or buy from him. That will be totally cancelled. On 26, you came to me. First on the spot, first what I want to do is, I want to cancel the original contract. Okay, tell me now. Customer is trying to make a forward buy. Therefore, bank has entered into a forward sell originally. Okay. For the original forward sell, what is the reversal? For the original forward sell, what will be the reversal? Reversal will be spot buy. On 26 spot buy. Okay, 26 spot buy. Okay, you check the rate first. So, first on 26 spot rate. Okay, on 26 spot rate, tell me. Bank with our customer has to make a spot buy to cancel it. Bank buys at a lower rate, a higher rate, a lower rate. Lower rate will be bid rate. 6800 6800 adjusted to margin. But you need to understand, this 63.6800 is a contract newly created for seller just to cancel the original contract created. To cancel that 64.40, we are using this. Therefore, this is called as cancel rate. What rate it is? Cancel rate or cancellation rate. Customer again said that I want transaction to expire on 10th August. Okay, new contract please create. 64.40, okay. Now, bank has to enter into forward sell. customer has to forward buy, bank enters into forward sell. New contract we have to create. Okay, new contract we have to create. Okay, new contract you have to create. What rate you will create? 26 expiring 10th August. Okay, tell me. 10th August. They didn't give 10th August to 20 August. Na? Assume that these rates are 10th August rates. Because no other information is available. On 20th June for August rates. This is the only information available. Tell me. Customer will buy. Bank has to sell. Bank sells at a higher rate. Higher rate will be ask rate. Higher rate will be ask rate. 64.2500 will be the rate. Rupees 64.2500. Again new rate na adjusted to margin. This rate is customer's new rate. Customer's new rate. So one is a cancelled rate, another one is a new rate. That's why he is asking new rate, cancellation rate, swap loss. All these we calculated. Remaining are only just working notes, we will do that. Okay. So these are the summary. Whenever question is given on late extension, 3 stages we need to deal with the problem. Customer, original contract with the customer, with the interbank. Next one, IBM we have cancelled it. 2 transactions. Let's again new contracts need to be created with the customers. Okay. One is for cancellation and the one is a new creation. These are the 6 transactions which we need to incorporate in the form of a problem. Answers will come. That's all. Okay. First, let us say do in our sequence. I'm not going by this sequence. I'm going by a logical sequence of the question. Okay. See here how to do. First, these are the summary of transactions. Okay. Customer, IBM. Whatever I have written there, I have already written the notes here. First, what is the step 1? Swap loss. On IBM cover transaction, swap loss is always between our bank and IBM. Already I said in the previous question. Bank buys new forward. Bank buys new forward. See here what we have done. First we entered into 64.80. Since we couldn't do, we have cancelled it or not. Take the rate. What is the rate? On 10th June, we made a spot sale at this rate. Okay. Made a spot sale at this rate. To swap this transaction, we entered into another transaction. That means with the IBM, I entered into 2 new transactions or not. Bank buys a new forward, 63.95. Cancel the original forward. So net loss is 0.1500. 30,000 is the loss. So always remember, swap loss transactions are between bank and IBM. Bank and IBM. Between what rate and what rate? New rate and the cancel rate. That means original contract you are going to cancel, take that rate. You have to enter into a new contract or not, take that rate. Both the rates difference is called as a swap loss. Both the rates difference is called as what, sir? Swap loss. I repeat, swap loss. Remember, by heart at least. Okay. At this stage, at least remember these steps. IBM is the one person. Our bank is another person. Our bank first promised to enter into one transaction. Because of the default of customer, I am getting defaulted to interbank or not. That particular rate at which you cancelled is one of the rate in swap. Okay. So bank cancels the original forward. Bank cancel original forward. What is the original forward rate? Original forward rate is for original forward rate is for a buy. Original forward rate is for buy. I said that I will buy at 63.8, but I could not do. I cancelled. I cancelled through 63.80. 63.80. 63.80. At this rate I cancelled. Okay, very good. But I created a new contract again to buy. That means today, okay, I have bought, I have made a cancellation at 63.8 and again I entered into a contract at 63.95. There is a swap loss between these differences or not. How much is swap loss per dollar? 0.15. Totally $2 lakh is there. 0.15 into 2 lakh will give me 30,000. One repetition last time. What is a swap loss? Swap loss is a loss which banker will incur with the interbank market. With which bank market, sir? Interbank market. With the interbank, our bank will enter into swap. Swap means changing the transaction. Original transaction is with the customer at 64. For that, I entered into transaction with 64.28. But I am honoring a cancelling. You are cancelling at what rate? By making a spot buy. Spot sell. So you reversed the transaction by making a spot sell. So to cancel the forward buy, you created a spot sell. So one sell happened today, one buy happened today. Netla you are having a net buyer, net seller, net buyer is there. So that's a swap loss. Okay. Next. After that, one step over. Swap loss completed. Next. Second one. Cancellation rate I am going to take. Original forward sell with the bank. Already I said. You are going to cancel. Original forward sell with the bank. 64.40 is the original contract entered. Forward sell by the bank, original contract. But we are entering into transaction not honoring or not honoring. Means, see here, this transaction. Customer will cancel. One second. I will just. Okay, see here. Originally, customer said that he will buy at what rate? 64.4000. That means bank said that I will sell. But really you are buying, you cancelled. Therefore, I also have to cancel with you or not? So the cancel rate we have already said as 63.68. 63.68. This is forward sell by the bank. This is forward sell by the bank. It is closed with the spot buy. Spot buy means how much? 63.68. Buying means margin will be reduced again. It will make buying price much lower. 63.68 minus 0.1%. Okay. It is 63.6163. But I said that round off to the next 0.0025. So plus 0.0025, 63.61. Sorry, not add. Sorry. I am very sorry. Directly you need to make a round off. So 63.6163 na, this will be rounded off to 63.6175. 63.6175. That means 0.5 after everything. Next, below that we will go to previous number. So 63.6175. That's what we have taken. So cancellation rate means original contract entered with the bank with the customer. IBM over with the customer. New rate for this we need to cancel at 63.6163. That is 61.6175 is a rounded off number. So 64.400. Okay. 64.400. We already entered original transaction. That original transaction is entered by the bank with the customer. Okay, bank with the customer, and bank original transaction entered, and it also cancelled a transaction which has already entered with the customer. For that cancellation, we need a spot buy rate we have taken. That's called as a cancellation rate. From the customer point of view, also same. Okay, customer said that he will be buying. Okay. He will be buying at 64.400 like that, and he also cancelled the contract. We created a new contract rate. This is how this particular cancellation rate is determined. Okay, 64.40 minus, okay, that is a selling rate, minus 63.6175. 0.7825 into $2 lakh came to 1,56,500. 1,56,500 amount payable by the customer. So amount should be payable by this particular customer. So summary is swap loss transactions will be between between bank and IBM. Which one? Swap loss. Bank and IBM means what? New rate, cancellation of agreed rate. Both we will calculate swap loss. Cancellation is between banker and the customer. Original contract you created, we cancel through another rate. It is a sale rate and second one is a buy rate. This is a buy rate. So the balance I will collect as a cancellation charges from you. Next, number 3, new contract rate on 26. See here, this is the new contract rate. Summary I will show you. Okay, 64.25 na 64.25. New contract rate, banker enter into forward sell. Sell means they will add margin. 64.25 plus 0.1%. 61.3142. 3143. Okay, 3143 we will take it as 3143 rounded off to 3150. So 3150 is the new rate. 64.3150 into 2 lakhs 1 crore 28 lakh 63,000. This is the total amount payable for $2 lakh. So swap loss over, everything is over, new rate is also over. 63.3150, 68.3150, something, some amount we have already done. 64.3150 amount payable on $2 lakh is also completed. Lastly, interest on outlay of funds. Let us see. Interest on forward outlay, fund outlay. Original deal with IBM, 64.28. I said that I will buy. Okay. I cancelled with them or not? Yes, I cancelled. Because of that, because of you not coming, I have to cancel the contract and I have made a extra payment. That means I cancelled and I made a loss or not. Original deal with the IBM is 64.28. I cancelled it. Okay, I have cancelled it. I have cancelled it at 63.80. You can see this. See here. I said that I will make a forward buy at 64.28 or not. Yes. That was really on order. I cancelled. I cancelled at what rate? 63.80. So therefore, 63.8 is a sell rate minus 64.28 is a buy rate. 0.48 there is a loss on each dollar or not? Yes. 0.48 into 2 lakh 96,000. 96,000 into, calculate the interest. 96,000. Calculate the interest. See here. I have entered into a original covered deal with the IBM at 64.28. This is to buy. But because of you not coming on the same date, okay, on a 10/6, I cancelled by making a spot sell. Sell is lower, buy is higher. I made a loss. I have to make a payment. 4.4800 is for $1 into 2 lakh give me 96,000. Okay. Again, when the customer came and paid the cancellation charges, etc., all these things, on 20th June he came. For 10 days there is a loss or not? So 96,000 into 12% into 10 by 360. 96,000 into 12% into 10 divided by 360. 320 rupees is the answer. Interest on outlay of funds is 320. Total cost, cancellation charges, swap loss and interest, 186,820. This is how this problem has to be done. So no confusions in this. So you have to remember that summary transactions are more important. First time everyone will feel confused. Working whatever I have done here, you note it separately and do 2-3 times the same problem. Whenever you find time, you will feel comfortable after a period of span of time. So swap loss is between two banks. Okay, one bank with interbank. Cancellation rate, bank with customer, original forward and cancellation of forward, between those. New contract rate means new rate you create. That is as simple. Outlay of funds is for the time lag, between what and what? Between IBM transaction cancellation and you coming and doing that. Then it means whenever I call interest on outlay of fund, you should take the transactions with IBM. Two IBM rates are there. Original contract, cancellation contract. In that you got a loss. If you get gain, inflow. If you get a loss, now outflow. For the period, Okay, for the period between that, you need to calculate 320, and this is the total payment. That's all. This is the end of fate of forward. So many persons are consistently asking this. So I made a video also on this. Hope this is understandable. Fastly, I completed all the concepts. If you have any doubts, put in the comments below. I will answer.